Hey everyone, it's FinTech, and welcome back to another stock analysis. Today, I'm going to look at a company which everybody has heard of, Zoom. Zoom is the company whose video collaboration and meeting platform took the world by storm a couple months ago. Zoom's stock this year has been almost unstoppable, and it has been my best performing stock by far. But with an earnings report coming out Monday, August 31st, it made me ask the question, will Zoom continue to outperform everybody's estimates, or will people expect too much from the company and once it hits its next earnings release, is it going to drop? Now, I'm going to focus this analysis primarily on Zoom's revenue. The reason for this is a lot of really high growth stocks, including Zoom in the past, aren't actually profitable. And so if you try to just look at profits, it makes it difficult to compare performance quarter to quarter. If you look at revenue, however, it's easier to see how quickly the company is growing, as long as you can assume that the other metrics stay roughly the same. To start out with, let's look at Zoom's previous earnings report and look at what it forecast for the future quarters. Last quarter, Zoom reported earnings of $328.2 million, or up 169% year over year. They then forecast that for the next year, they would make between $495 and $500 million. Now, as I'm going to run this analysis, I'm going to focus on $500 million at the high end of this range, because I believe that most other people expect Zoom to perform on the higher end of its estimate. This is in line with analyst estimates, which say that Zoom will make $498.8 million or 45 cents earnings per share. What's crazy is that this represents growth of over 240% year over year, or the equivalent of the company being 3.4 times bigger than it was a year ago. Another way to think of this is the company's growing over 50% sequentially on top of the massive growth that it's already had this year. And remember, that's just to meet expectations. Okay, so that's the information that we had at the end of last quarter. But then the next question is, what information can we gather between then and now to help us determine what earnings are going to be announced on Monday? Well, I found this really interesting article on Seeking Alpha about KeyBank. KeyBank is just a bank, but because they're a bank, they have a lot of debit and credit card info. They then use this information to try to create models of different financial situations, including how much revenue a specific company is booking in a given time period. According to KeyBank, Zoom's billings are up 32% quarter over quarter. This is compared to a consensus forecast of negative 15% quarter over quarter. Basically, most people are predicting that Zoom is going to bill a little bit less than it did in the previous quarter because the hype around it has died down a little bit. Yet KeyBank's credit cards and debit card information is saying that Zoom is actually booking an additional 32%. Now, the Seeking Alpha article that I read provides some caveats to this. Mainly the fact that just because this credit card and debit card info shows that Zoom's bookings are up, doesn't necessarily mean that Zoom is going to recognize that as revenue. If you saw my previous video analyzing Alteryx's stock, you'll know that very simple changes in accounting can make a company's performance look wildly different. For Zoom, for example, we don't know how they're going to recognize a given customer in terms of billings. Are they going to recognize a big chunk of that up front? Are they going to spread it out over the term of their entire contract? Maybe they're going to recognize more of it later. KeyBank's data noted that a lot of customer acquisitions weren't customers that weren't using video in the past. They were instead winning customers from other video conferencing platforms. Zoom will offer to buy customers out of their existing contracts in order for them to move over to Zoom. In this case, what Zoom will do is they'll bill the entire cost of the customers up front, but then in order to make up for the cost that those customers have to pay to the other contract, they'll take out a little bit of the billings every single subsequent quarter. Basically, this will make Zoom's billings look artificially high for the first quarter when they book the customer, and then they'll fall back down to how much money Zoom is actually making in subsequent quarters. This is important because that 32% quarter over quarter growth might just be because Zoom is booking a bunch of customers up front, and that's artificially inflating their numbers. Quick pause here. If you guys are enjoying this video and you like this type of analysis, make sure to leave a like on this video. It really helps out with the YouTube algorithm. All right, let's get back to it. So now we have all these numbers. What do we do with them? Well, my thought process is first, let's estimate what percent of Zoom's billings it expects in this specific quarter that they're announcing earnings for. So first, we need to look at what their estimate is for the entire year and try to work back for what that means their estimate would be for just this quarter. To do that, let's take the earnings that Zoom expects, which is $500 million, multiply that by what percent they're making compared to last year. Now the consensus estimate is down 15%, so multiply by 0.85. Then we need to divide by 4 because this is only one quarter out of the entire year. This gives us a final number of $106 million in billings expected for this particular quarter. This number is my best estimate to what the market is expecting Zoom to report this quarter. But now let's rerun the numbers using the new information we have from KeyBank. Now KeyBank says that they grew 32% quarter over quarter, but I told you that that's probably a little bit of an overestimate due to how Zoom is booking a lot of these customers. So let's cut that number in half and say that Zoom grew customers 16% quarter over quarter to make it a conservative estimate. We then run the same calculation, $500 million, except this time times 1.16 to get the revenue for the year, and then again divide by 4 to get the revenue for just this particular quarter. This would give us quarter 2 billings of $145 million. If we then take the difference between $145 million and $106 million, we come up with $39 million. Let's then add this to Zoom's estimate because let's assume that they're only going to outperform this quarter and not subsequent quarters. This would mean that we're getting $500 million plus an additional $39 million for the entire year. This means that just based on this very conservative analysis, Zoom would beat estimates by around 7.8% in terms of revenue for the year. Now, there are a couple assumptions in there that we need to break apart. The most important one is the idea that exactly one quarter of the year's revenue is going to be recognized in quarter 2. Like I mentioned earlier, if Zoom is winning over customers who already have existing contracts with other companies, Zoom is going to cover a certain amount of that contract. This means that Zoom's billings in Q2 could be a little bit lower because they're not recognizing as much in that quarter, or maybe it could be higher than it really should be because of some kind of sales contract they have negotiated. This is where a graph comes in handy because we have an independent variable, basically what percent of their revenue they're going to recognize this quarter, and then we have a dependent variable, which is how much revenue they'll have for the entire year. So if we go ahead and chart this, we get these results. This chart basically shows that if they were to book 0% of their revenues in Q2, what KeyBank's data noted that they were selling more basically has zero effect on the revenue for the year, and they only have $500 million. Now, obviously, this isn't going to happen. They're going to book some percent in this quarter. So let's look at a couple different numbers. Let's say only 10% of the revenue for the year was in this quarter. Well, in that case, they'll still make $515 million, which is still a beat over analyst estimates. If they make 25%, they make $539 million, like we talked about earlier. But what if they recognize a greater percentage in this quarter than in other quarters? For example, if Zoom recognized 50% of their revenue in this quarter, they would make $578 million for the year, which would be a beat of closer to 15%. Based on this, it seems like Zoom will definitely beat its earnings. The only question is, by how much? On a less technical level, I've been seeing a lot of articles written recently talking about a major outage that Zoom had last week. Surprisingly, despite the negative press coverage, Zoom's stock price really hasn't been affected, and its price has continued to rise over the past month. Maybe this shouldn't be that surprising because these articles remind me a lot of the articles that would come out about Tesla crashes. Back when Tesla was still a newer company and their self-driving technology was still getting off the ground, it seemed like every time a Tesla car got into any kind of minor accident, there would be a news article written about it. This was despite the fact that Tesla cars were proven on average to be safer than normal cars. This is similar to Zoom, where it seems like anytime Zoom has any kind of minor technical difficulty, there are news articles written about it. Now, these articles ignore the fact that in the vast majority of cases, Zoom is the best video platform out there. It is still interesting, though, that Zoom investors are so confident in the company that these articles really don't affect the stock price. It's entirely possible that investors are just overconfident in Zoom based on its blowout last quarter. This, combined with the fact that the stock price has risen so much over the past month, leads me to believe that the stock price already has a little bit of a beat factored into its price. Basically, the market is expecting Zoom to beat estimates at least by a little bit. As it stands, the stock price has risen by about 10% from where it was in July. So what will happen on August 31st? We can only speculate, but I think conservatively, Zoom is going to beat estimates by between 7 and 15%. Now at this point, I'm curious, what do you think? If you have any opinions around what you think is going to happen to Zoom, leave it in the comments. I read all of them and I respond to pretty much all of them. With that said, I hope you enjoyed this video. If you did, make sure to leave a like. And if you want to see more videos like this in the future and not miss out on any future uploads, make sure to subscribe. I'll see you next time.